Equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity, mate. Episode 9, the podcast made by nobodies for everybody, where we break down the world of investing from beginning to dividend to make it more investable for you guys. Welcome. Here with Ren.
Hey everyone.
Buddy. And we've got a pretty jam-packed show for you guys today. We're going to kick off with our investment portfolio, our hypothetical investment portfolio that we haven't updated you on in a while. So we'll kick off with that and then go into some news, as always, straight into stock of the week, and then a bit of a basics 101 to do with ways that you can start good habits for investing.
Yeah.
So what do you reckon, Ren? We'll kick it off with the portfolio.
Yeah, we've been pretty quiet about the portfolio of late, but you know, we've been preaching on the show that don't look at your short-term results, invest with a long time horizon. But, you know, if things are going well, it's always good to talk about it, I guess.
Yeah, exactly. It's always fun looking at.
Yeah, I mean, it's sometimes fun looking at your investment results.
True.
Yeah.
We're in a very fortunate position in that all three stocks that we've chosen in the stock of the week have performed reasonably well since we did our purchase.
Yeah.
They're all up, which is an unusual thing to happen.
Yeah. So
it's not always rosy.
So why don't we just quickly go over what we've done as our stock of the week so far?
Sure.
We've had 3: Gateway Lifestyle Group, then a listed investment company, PM Capital Global Opportunities Fund, and then Australian Agricultural Company. And between the three of them, we're up 11%.
What's that in dollars?
So $327.45 off a cost basis, or how much we invested to start with, of about $3,000.
Nice.
Yeah.
I'm pretty happy with that.
Yeah, very happy with that. So
good to see everything up.
If you want to follow our stock of the week, jump on our website, equitymates.com. We've got a live tracker up there. You can see all of our investments and how each of them are going. So we're really putting ourselves out there, and fingers crossed they don't tank. Look, as we always say, we're not expert stock pickers by any stretch of the imagination. We're just doing this to show what consistent, disciplined investing can lead to. You know, if you're just investing a little bit every now and then over time, the results will accumulate. And we just want to show that and have a bit of fun with some stock picks while we're doing it.
Yeah, exactly. Nice. All right, moving on. News. There's a lot been going on this week. We've had, the budget. It's been the end of reporting season in the US. We've had the French election.
Yep.
It's been pretty jam-packed and a lot of stuff that we could talk about. Yep. But Ren, you want to kick off with something?
Yeah, so look, we'll always try and keep the news pretty investment focused on this podcast, and there's no bigger time in the investing calendar than the Berkshire Hathaway annual meeting. Damn. Now, this has been nicknamed Woodstock for capitalists, and what it is Warren Buffett's investment company, Berkshire Hathaway, every year has a weekend in Omaha, Nebraska, where Warren Buffett speaks, and all the companies that Berkshire Hathaway owns, have stands there, and it's a big festival of capitalism, as they like to say.
What did you take out of this one?
So my big takeaway was Warren really pushing passive investment options. Now, we've spoken a little bit about passive investing on this podcast. That's when you sort of buy an index fund or an exchange traded fund, which is essentially you buy into a fund that holds a number of shares and doesn't buy and sell those shares. So, for example, you could buy into the ASX 200, which is just the 200 biggest companies listed in Australia. And regardless of how those companies are going, the fund just holds those shares. And so Warren called out the founder of a company that established a lot of passive funds. It's called Vanguard. He spent a lot of time ripping on the fee structure of hedge fund managers, and he had a quote that unlike dentists and plumbers, hedge fund managers add no value. So
he's been hating them for a long time.
He didn't mince words at all. He's liked passive investing for a while, and he said that when he died, he wanted 90% of the money he left for his wife to be invested in a passive fund. You know, that's something that he's really pushing as he gets into his later years in his life. And I mean, it's something that people who are new to the market, it's probably advice worth listening to. If you want to dip your toe in, passive investing is always a good way to go about it.
Yeah, just for our listeners, in terms of when he's talking about low fees, he's talking about fees that are paid to the hedge fund managers, as well as frictional or transactional costings and fees that are involved in that. And one of the beauty of passive investing is that in leaving your money in the market, you avoid having to pay continuous brokerage fees for pulling out your money and putting your money back in. And over years and years, brokerage can add up to quite a significant amount. So the least amount of trades you can do, in some instances, the better off that you will be.
Yeah, absolutely.
All right.
Do you have any takeaways from it?
No, I mean, I agree with all of that. I have, just as yourself, love Buffett and starting to read a lot about this passive investing, and because it's starting to become a big trend at the moment, almost like quinoa or kale. And it's interesting to see how hedge funds are now starting to react to the idea of passive investing, because people are starting to pull large sums of money out of hedge funds and traditional forms of investing in the market and putting them into companies such as Vanguard. And of course, that's not going to make the fund managers very happy. So,
no, not at
all. I think it's a fantastic way of investing.
Yeah, definitely. All right, now on to our next piece of news. The budget just got handed down.
This year has been obviously a mixed reaction, as it is every year. A few of the big takeaways for ourselves and for you guys is that in this year's budget, they have created some measures to support first home buyers, because obviously at the moment it's a very political point with housing affordability in Melbourne and Sydney out of the reach of many. So one of the main things that they have done is allow up to $15,000 a year in your superannuation. So essentially that means that you can sacrifice pre-tax up to $15,000 of your annual income to a total of $30,000 into your superannuation account, which will give you a lower tax rate than if you were to save it, after tax.
Yeah.
I don't know. What do you think about this? I think it's a negative sum game because I think that it's a good way to encourage people to put money away, and it does give tax benefits. But I also think that it's not really answering the immediate or the most pressing issue, which is supply in the major cities.
Yeah, definitely. Look, I have a couple of thoughts on it. The first one is that you're right. It doesn't address supply, but what's more, giving first home buyers these tax advantages is only going to incrementally drive up the price that first home buyers are able to pay.
Yeah.
So look, that in itself doesn't address house prices per se, but in some ways it levels the playing field for first home buyers.
Yeah.
The other interesting thing to think about is that the way people's super is invested when they're young, which most first home buyers are, is that it's invested quite aggressively. So because we're young and we've got a long time horizon, there's a much higher tolerance for risk. And so it's an interesting dilemma, because as a super fund who's investing for someone who's, in their early 30s, you are able to take risks because you know there's a lot of time to recuperate that if you lose a bit of capital, and there's a lot of upside there. But as a first home buyer, and when you're talking about someone's deposit on their house, your focus should really be on capital preservation, which is investing to not lose the money that you have.
Yeah, you don't want to be saving $15,000 of your income up to, and then the market crashes and you lose 60% of it.
Yeah, exactly. So it's an interesting dilemma, and there are some obvious fixes for that. Super funds can offer a separate investment option for your house deposit fund, Look, it's just something to be mindful of as young people who are looking to buy a first house and looking to take advantage of this budget measure. Just look at how your super fund invests, look at their risk profile, and just, consider that when you're doing it.
Another thing that was interesting was that the government have introduced restrictions on foreign investors, which has also been driving the price up. A lot of money from overseas coming in and purchasing houses, and in some instances they're purchasing property for investment and then they're not even living in it.
Yeah.
They're just putting it there to sit money, or even renting it. So the government have come in and said that we will tax on houses that are left empty. I think it's a $5,000 tax. Now, personally, I think this is nowhere near enough for it to even make us a solid impact. $5,000 for someone who's bought a property in Vaucluse for $12 million is pocket change.
Yeah.
And at the end of the day, you're going to get that $5,000 back on capital growth most likely. I don't think it's enough to deter people from buying houses and sitting it. I think it could have been a lot harsher, or they could have done something else to discourage. I don't think it's a continuous tax. I think it's just a one-off payment. If it was a continuous year on year, then that I think would have been a bit better. But
no, I think it is. I think it is continuous.
It is year on year.
Yeah, it wouldn't really make sense if it wasn't year on year.
Maybe, yeah.
Yeah, I actually don't know. We should have done more research. But look, I take your point that it's not a whole lot, but the important thing is for some foreign investors, it might change the incentives, because if it's going to cost, say, $5,000 a year to pay this fine, essentially, or it will cost a couple of grand to just engage a property manager and let them deal with renting it and all that, then that incentive structure might change, and they might go to the effort and get the property manager in to do it, whereas before it wasn't worth the effort. But look, I think that any move in the direction of ensuring that property investors still allowing people into the homes that they own to rent them is a good thing, and hopefully it's the start of a real concerted push by the government.
Definitely. Okay, cool. So a bit of a fun news story to finish it off is to do with Apple, and we've mentioned before that they have a huge amount of cash sitting offshore, $220 billion of cash that they are waiting to repatriate back into the United States, which Donald Trump's hopes that he can achieve. And Ren, I know you enjoy talking about this, so what's the story we've got here?
So Donald Trump in his campaign was constantly talking about this money that a lot of companies have parked overseas. Apple is leading the charge with $250 billion parked overseas. And essentially the reason that it's parked overseas is because American multinationals get taxed on their overseas profit when they bring that money back into America. And the corporate tax rate in America is something like 35%. So for Apple, it doesn't make sense to bring that money back into America and have to pay 35% tax on it. Why don't they just keep it overseas? And then what they've been doing in America is raising debt and just letting this cash pile build overseas. Now, the Donald wants to get American companies to bring that money back in the hope of creating some American jobs out of it. And so what he's offering is a one-time tax holiday of a 10% tax rate if they bring their money back. And so Apple has, I think it's these days, like $255 billion overseas. So if they bring that back, they're going to have a very nice chunk of change to make some investments with.
So what's the story?
So Citigroup have bought into that hype a little bit and put together a list of 7 companies that Apple might try and buy. Now, look, no one realistically thinks that this is what Tim Cook is thinking of actually buying, but it's nice to imagine, and some of them actually do make a little bit of sense.
What are they?
So the first one, which everyone has heard of, is Netflix. Now, just to give you an idea of how big Apple is, Netflix market cap, so if you bought every single one of their shares of their company at the market price right now, it's $67 billion. So Apple could buy Netflix and still have about $150 billion in cash left over. Now, the reason Netflix makes sense is because Apple's been making a push into online streaming and haven't seen a lot of success thus far. Some of the other ones, Tesla, Elon Musk's car company, because Apple also are trying to make a push into self-driving cars. Tesla's market cap is $52 billion. So hypothetically,
buy
Apple
4 Teslas.
Yeah, Apple could buy Tesla and Netflix and still have a lot of money left over. And the last one that I thought was quite interesting was Disney. Now, Disney are a huge company when you look at everything they own. Obviously, the main Disney brands, but then also Pixar, also ESPN, a bunch of other cable channels. They are a huge media conglomerate. And yet, their market cap, $176 billion. So
Nothing.
Apple could pay cash and have some left over.
They could pay cash and buy a Tesla.
Yeah, they could.
Yeah.
So,
And
look, no one actually reckons that Apple will buy Disney. And if they were going to buy Disney shareholders would demand a huge premium. But look, it just shows how big Apple is. It's the biggest listed company in the world. It's competing with the government-owned Saudi oil company to actually be the biggest company in the world. But it is just huge.
Huge.
Yeah.
All right. Well, that brings us to Stock of the Week. So this week's Stock of the Week is a company called Afterpay, a small Australian company that floated on the Australian Stock Exchange, so became publicly listed in around March 2016, and it floated for $1. So you could have purchased stocks at $1, and I think it's now trading at around $2.55 after hitting some highs of about $3. So it's had some pretty good growth in the last, just over 12 months. It's a small Australian company that is in the online payments space. It was founded in 2014, and it is one of Australia's leading retail payments innovators.
All right. So what do Afterpay do?
Well, essentially, they are an e-commerce business that facilitates payment transactions between merchants and their end customers. So essentially, it's a platform that links up with, say, a business such as Maya or The Iconic, and they provide a service for customers to pay for their products without having to pay for their products. What Afterpay do is they offer a buy now, receive now, but pay later service that essentially doesn't require end-to-end, or that doesn't require the customer to enter into any sort of loan or pay any upfront fees.
So simply, it's lay-by.
Yeah, that's online lay-by.
Yeah, so it's
you're not paying any extra for the product. You're not engaging any loan or taking on any credit. But the difference between this and lay-by is that you get the product right now. Lay-by, you don't get the product until you finish off paying it. Whereas this is, you get the product sent to your door. You get it exactly as if you had paid for it in full, but you can engage in I think it's usually 4 payments of X amount of dollars.
Yeah.
So that's one side. The second side is that you can also get an Afterpay app on your phone, and to all of the retailers and merchants, not necessarily just fashion, but they've hooked up with a Telstra and a few of the banks as well. You can get an app and go into these stores, and you can walk in and say, all right, I want to spend $100 on clothes. You then go into your app and tell Afterpay that you want to spend $100. It will give you a barcode to the value of $100, and then you can use that barcode at the cash register to pay for your items, and then Afterpay will work out how many payments from there on in you need to make back to them in order to pay off that item of clothing or TV or whatever it may be.
Okay, great. So I guess the big question is, if they don't charge people using, if they don't charge consumers fees to pay in installments, how do they make their money?
So they've got two forms of making money. Well, the main form is the merchant fee, and then I think they take a small percentage of the sale fee as well. So just like if a merchant's using an FPOS facility, they pay per transaction to use that FPOS facility. That's the same situation here. And also Afterpay skim a bit of the transaction percentage as well. So obviously the higher the transaction, the higher the amount of money that they can skim from that. Yeah, so that's how they make their money. And to give you an indication of how many retailers they've got signed up at the moment, they've got 3,700 merchants that are transacting live with them at the moment. And that's had some significant growth since they last posted some figures. And 15% of their processing is online retail fashion. So it's a pretty big market for them. If you think about Iconic, and they've teamed up with Maya and Taro Cash, for example, Factory, Rockman's. They've got a huge list online of all their retailers. And as retailers are now having to become more online, this is a very good opportunity for Afterpay to start consolidating their position in the Australian market, I think. And yeah, I think it's a very good idea. What I like about it is that it encourages people to buy more. And I don't know if that's a good thing or a bad. I don't know if that's a good thing or a bad thing, but I think that.
Well, it's a good thing for Afterpay.
It's a good thing for Afterpay. It's a good thing for the merchants as well and the retailers. But yeah, it's an interesting one. I think it's potentially a bit of a stab in the dark. I recognise that there are a number of factors that could prevent it from being as big as I think it could be. But I think one of the things I like about it is that there hasn't been anything specifically like this on the market, or as definitely as visible as it is now with leading online retailers. And I know that you can do similar things potentially in a similar way through payment service such as PayPal. But this one, I like the way that they appear online. I like the retailers that they are partnering with. I like how they make it seem so easy to do 4 installments of $50 rather than the psychological, I have to pay $200 now. I think that the merchants themselves are going to benefit a lot from this. So
yeah, and look, it makes sense. They talk about, the big shifts in the labour market and, the sort of gig economy that we're in nowadays, where a lot of people have casual jobs and then they supplement it with things like Uber and TaskRabbit. It's more and more likely that you're going to be paid casual wages. And in those cases, it's great to have a service where you can pay small amounts in installments. It fits more with weekly or fortnightly casual wage rather than, getting a monthly paycheck every month and being able to make big online purchases.
Yeah, that's true.
So, yeah, look, I like it. My big reservation is if Afterpay becomes a big hit in Australia, what's to stop Apple Pay or PayPal seeing that they're doing it well and offering a similar service? But, there's a lot of companies where you probably could have made a similar argument that have done quite well for themselves. So,
yeah, look, I don't have a specific reason that Apple Pay or Amazon aren't going to come and do something just like this. In fact, I wouldn't be surprised if they do. I just think that there is value in them being in the market at this time and getting their name out there and foot in the door and getting as many customers and merchants as they do already is definitely a big step forward, because the cost of acquiring customers is a metric that a lot of these big tech companies look at, and it's more often than not a better option for bigger companies to actually just buy these companies and all the customers and merchants that come with them, rather than try and create a platform that is similar in a new market and compete that way. So fingers crossed they do well. I think gut feeling is that they will be bought out at some stage by one of the bigger players. which would be a good thing for those who invest. But yeah, in terms of IP and that sort of stuff, I don't think there is anything that is severely preventing the big players from coming into the market.
Yeah.
And,
All right. We'll add that to our hypothetical portfolio.
Yeah, $2.55.
Yeah. Okay. So we'll put that up. We'll put a little write-up summarizing some of our thoughts. Everyone should jump onto Equity Mates and check it out. As we were saying before, the ones we've picked so far for Stock of the Week have done okay. So it's definitely worth, checking back every now and then and seeing how it's going and thinking about, how you can apply the lessons through that fund. Every now and then, just saving a bit and putting a bit into the market, how that can grow over time. That leads us nicely into our Basics 101.
Yeah, great little segue. I'm going to keep this pretty short because there's not much to harp on about, but the lesson is very important. And that is that there's a lot of value in consistency and time when it comes to putting away money for investing. Now, putting something away every pay that you get, be it fortnightly, monthly, weekly, or even inconsistently, if you're at uni and you're working a 3-day job or whatever it is, whenever you get a pay, I think it's very important that you can split that pay up and dedicate a proportion of it towards saving and investing. A lot of people often get scared about, I need $1,000 or I need $3,000 to start investing, and then they get out their calculator and work out how long it's going to take them to save $3,000 if they're putting away $20 a week. And it's daunting when it appears that, it's going to take them 2 years to save $3,000 at $20 a week. And so they just completely give up on it. And I think that's a really poor way of looking at how to tackle saving for your first investment and consistently saving from there on in.
Yeah, the other thing is, even if you decide you're going to commit to that savings goal, you might get part of the way there, have a big weekend, and blow a lot of that cash that's just been sitting in your bank account as you try and save up.
Exactly.
So,
which has happened before.
Yeah, exactly. Or you might go on an Afterpay binge and buy a whole lot of stuff online that you then have to pay off. So
yeah,
it's always dangerous just to have cash sitting around in your bank account.
Yeah,
and that's where the benefits of just continuously building your portfolio and growing it over time can really pay dividends. Pun intended.
Literally.
Yeah.
So there's 3 things that I want to mention, and your input as well, Ren, on what you sort of do from your end. But I want to talk about very briefly what I do with my pay, some habits in terms of setting goals, and then what options are out there for you to get into the market that don't require minimum $500 or saving up to $1,000. So firstly, in terms of pay allocation, as I said before, it's really important that you do split your pay up. I personally have a separate account, completely separate to my card account, so I can't blow it at the pub. And I have a set percentage of my pay that I put towards investing, and I do that every time I get paid, and I don't touch it until I get to my allocation, and then I put it straight into the share market. Or
what's your magic number? How much do you save before you put it into the market?
So that is changing over time. I used to save up to, obviously the minimum 500, up to 1,000. Usually once I would hit 1,000, I would just put that in the market. Now, that didn't mean I would be buying different shares every time. I'm a strong believer of cost-price averaging, which is buying the same shares, obviously just at different prices, which in the long run can give you benefit. So yeah, I would initially.
So just to explain that to our listeners, if stock prices move obviously, and if you're buying $1,000 of a share, every 3 months, say, and over a year you buy it at, $1.50, and then it drops to 50 cents, and then $1 again. That means even though you had paid $1.50 for it at one point, and you got a bargain at 50 cents, at the end of the day, your average price across the whole year is $1. And so It's a good way of averaging out the highs and lows of the market as you buy more and more of the stock.
Exactly.
Yeah.
And we'll definitely talk about that later on. So to give you an idea of how I allocate my pay, I roughly split it into thirds. Obviously, I've set myself a budget and I know how much I need to spend each week on the necessities, so bills and food and all that sort of stuff, allocate that. I know how much I need to save, and I know how much like my living costs are with rent and that sort of stuff. And that just happens to come out at about a third of my pay, roughly, give or take here or there.
Yeah.
And obviously, if you put a third away for savings, that can be split half savings for a holiday. But obviously, I encourage you to really put it into at least some into the stocks as well. So that's the first thing. And that leads into habit and consistency. Doing it every pay into an account that you can't touch or that has high interest, that's not related to your card, is a good way for you to start understanding the value of time. Because before you know it, 6 months will go by, a year will go by, and you'll have, quite a considerable sum in there for really no effort. It's also really important, I think, to have a goal that you are trying to achieve. So say, for example, a great goal would be saying, I need $500 to invest in the stocks first time. Try and save for that without breaking your bank, and aim for that and just try and stick to that by being consistent. And I think that working towards that goal will give you a sense of, it feels good working towards a goal, and it's not going to be as daunting than taking 500 out straight from your pay and then not being able to live for the rest of the fortnight. How do you do yours, Ren? How do you split yours?
So, unlike you, I am terrible at saving and budgeting. So, I would love to be able to stick to a third rule, but unfortunately, I can't. So, what I do, I set up a saving account with my bank, and so whenever I get paid, I try and transfer into that. The problem is it's too easy to transfer out of that. But look, there are definitely resources out there that can help you. So one of them that I quite like is it's an app called Pocketbook. And what it does is you can link it with your bank account, and it will look at all the transactions that are going on your spending account, and it will, sort of categorize them, and it will give you some insight into it. It breaks down how much you're spending, what you're spending it on. And when you see you've spent like 40% of the money you had this month on, like food and booze or, whatever, that, all right, maybe you need to just call it a bit. So it's a good way of really visualizing your spending and your saving, and you can put, your goals in the app. So
I like that.
I have like a saving goal, and I put all my bills and when my rent's due and when I get paid, and it sort of calculates it all for me. So look, it's by no means the only one. Like, I'm sure there are hundreds out there on the App Store and the Google Play Store. So do a bit of research, but Pocketbook works well for me.
I like that because it's still teaching the principles of allocating your money, and that you're putting in a goal and how much you need for X, Y, and Z, and it's just doing the creation of the figures that need to come out the other end for you.
Yeah, definitely.
It's also, I like it because it's giving you an understanding of where you're spending your money. The worst thing that, as we started this, is that you go out to the pub or go on a holiday for the weekend and then blow it all, and you think, oh man, I'm back to square one. If you can recognize where your money's going and tweak it, then you're halfway there.
Oh, I mean, we've all had the thought, like, where did that paycheck go? Like, I only got paid, 3 days ago or a week ago, and somehow I've blown a lot of it. This way, at least you can see, like, the 4 Ubers I took, that was $100, and like, oh, my phone bill came and that was another $100. It's a good way of just keeping track, because no one likes scrolling through bank statements. So, getting a nice little pie chart changes it up a bit.
Yeah, nice.
Then look, when I do save, my general rule is I try and pay only 1% brokerage for my investment. So I now have a CMC account which charges $8 brokerage.
Yep.
So that means I want to invest at least $800 at a time, just because if you're paying 1% brokerage, then the stock has to appreciate or go up in price 1% just for you to get back to even. So, if you're doing $500 hits, and let's say you're paying $50 brokerage, that's 10% of your investment. And so that means the stock has to rise 10% just for you to break even. So that's my general rule. Obviously, different people have different rules, but that's something that I try to stick to.
Yeah, interesting. It's a good point, and definitely something that you probably thought about a bit after you've had a bit of experience with investing as well, and you came to understand that brokerage as a percentage does actually have an impact on how much profit you can make later on down the track.
Yeah, but look, don't get scared off by that.
No, definitely not. No, being in it is better than being not.
Yeah, definitely. Over the long term, 1% isn't going to make you lose any sleep at night.
No.
Be in the market.
So secondly, I think it's also important to note that having a high interest account is very important for these sorts of things. For example, I know ING have a good high interest account. I think it's paying about 3.5% at the moment. So having your money in there working for you, even though you might be getting small amounts of money, it all adds up in the end.
Yeah. And most banks have, like goal saver accounts or the equivalent, where if you put X amount of money in and don't take any money out, then you get bonus interest or bonus payments. Just look at your bank and look for stuff like that, because they're out there. Yeah.
And definitely. And look, what we're saying is nothing new. This is in like every single personal finance book and investing you can talk about. But I think it's just important that you just got to do it. That's the thing.
Yeah. There's a reason it's in every personal finance book. It's a good rule and it works.
Yeah, it works. It works, without fail. And you'll be surprised how quickly life goes by, how quickly your weeks go by, and you forget all of a sudden about the money that's going into these accounts, and all of a sudden you flick over and, if you were to put $50 a week away, you'd have $2,600 by the end of the year to invest. And I'm sure if you said to someone flat out, try and save $2,600, they'd be like, oh, come on, mate. Like, I don't have the ability to do so or whatever. What it takes is a small amount each week. So the other thing is there are alternatives to getting into the market without having to save large chunks of money. And they're all coming through, fintech at the moment. Some great apps that are available. I'm a big fan of an app called Acorns. Now, this app allows you to get into the market with as little as $5. I like this app for a number of reasons. One, because it teaches the discipline of, well, not necessarily the discipline, but it gives you a very good idea of compound interest and consistency in putting money away. Essentially, what Acorns does is you attach your cards and bank accounts to it, and then every time that you do a transaction, it will round up that transaction to the nearest dollar and take that rounding and put it into the share market. So, for example, I buy a coffee for $3.50. It will round up to $4, and it will take 50 cents out of my account and put it into the stock market. Now, the monthly fees on this are quite high as a relative proportion to how much you would be putting in if you are just relying on the cents that were going in, because it literally is cents. You might be putting in $5, $10, $15, $20 a week or a month, but it is literally cents. I think, though, it's great if you combine that feature of the app with adding in your own money. So what it allows you to do is you can put in either a recurring amount of money, and it will withdraw that money from your account either monthly, fortnightly, or weekly. You can set that amount, whatever you like, as little as $5, or you can put in lump sums as well and use it essentially as a saving account, keeping in mind that the money in there is invested in the stocks, so it is exposed and can fluctuate. It's not as safe as putting it into a bank account, but the returns I'm getting on it at the moment are far greater than what I would be getting from interest in a bank account. Yeah. I personally am putting in my own money each week as well, and I think having it set for a consistent amount teaches a really good habit. And as I said, before you know it, you've got hundreds of dollars in there, which you can then take and invest yourself in the market.
Yeah, definitely. Look, so they charge $1 a month. So if you're just rounding up your coffee a couple of times a week, and say they're investing $5 a month, then it's 20% of your investment in fees. Yeah. So then the maths just doesn't work. But if you're doing what you're doing and using it as a sort of weekly or whenever you get paid, like investment/savings mechanism as well as your spare change, that's when the $1 a month fee starts to make sense, and it's a good, cheap way of getting into the market without a lot of capital.
Yeah, exactly. You're definitely right. If you did it without putting money in, it's an expensive way of getting access to the market. It also allows you to have a fiddle around with portfolio weightings, so you can have a look at what an aggressive portfolio looks like or a conservative portfolio, and they do it in a nice fancy way and a modern look on the phone, and you can flick around on the train and all that sort of stuff. So it's great. I like it, and I think if people can do it in the right way, it teaches some great habits. I also think that I also like two other apps, Stake and First Step, and they're both. Stake in particular is a micro investing app, and what it allows you to do is similar to Acorns, use small amounts of money to invest in parts of stocks. So say, for example, you want to buy Google. It's currently, over 1,200 Australian dollars. That's way too expensive for someone who's just starting out. Stake allows you to buy a proportion of a stock of Apple. So you can pay $10, for example, and you'll get the equivalent of you'll get a share of an Apple stock. So it's just a good example of another way that you don't have to save up the minimum 500 to get access.
With those ones though, so obviously part of owning a share is getting the capital appreciation, so that it growing in price, and you being able to sell it for more than you bought it. With apps like that though, what happens with dividends and stuff like that?
I think it's still proportionate because... Oh,
right, okay. So if you own 1% of a stock, you get 1% of a dividend, essentially.
That's right. Okay. Yeah, because I have a feeling what happens is that you're going through this company which owns the stock.
So they're just essentially...
They'll cop it. They're just a broker.
They're like a holding company for millions of micro investors.
That's right. Yeah.
Right,
and they will distribute any dividends accordingly to whatever percentage of the stock you hold. So just another. It doesn't encourage you to put money away or anything like that, but it's a way in which you can access the market without needing hundreds and hundreds of dollars. You don't have to save that minimum 500. You can get in straight away. Obviously, I encourage everyone to look at the terms and conditions and the fees with these sort of things, because the smaller these companies are, the more likely the fees are on the higher side. But a great way to get international exposure and to not have to spend huge amounts. You can just have a play around with it at the end of the day.
Yeah, definitely. And there's heaps of apps like that. Some of the other ones out there like Robinhood, Clink, there's a bunch. So, do your research, see what you like. It's a good way to dip the toe in the market.
Yeah, well, that's it. Put something away consistently, get into the habit of doing it. Time is on your side. That's the main thing. Be patient and you will get to where you want to be. Yeah. Set a goal, set up an account that's high interest and that isn't attached to a card that you go and buy clothes or go to the pub with. Yeah. And just get in there. Before you know it, you'll realize how easy it is and you won't look back. So that's that for the habits for continuous investing. Yeah, we might do a blog post on it.
Yeah, definitely. All right. Well, that brings us to the end of episode 9 of Equity Mates. We're ripping through the episodes. We're almost at double digits.
Oh, good. Have to have a party.
Yeah, thanks for sticking with us. And make sure you subscribe, give us a rating, tell your friends about us, play us really loud while you're driving with your windows down. And spread the word, because the more people we can have engaging with the show, and we can help on their investing journeys, it makes it worthwhile for us.
Yeah.
So thanks for listening, and until next time,
equity out.
Equity out.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.